Hey everyone, welcome back to Anderson Business Advisors. My name is Barley Buller. I'm one of the CPAs here at Anderson. Very happy to have you back. I'm joined by the manager of the tax advising department, Mr. Elliot Thomas. Hello, sir.
Hello, good to be here.
Yeah, tell them what we're doing today.
Today we're answering some questions that come from you. Exactly right. We got them from our clients.
That's right. And you know, we kind of have a little bit of an approach here. We'll look at the most commonly asked questions. We like to throw in unique questions, maybe ones that cover a lot of ground, right? We'll hear a lot of the same kind of questions. So all your questions, though, is the bottom line. So very happy to have you guys here. Tune in. Where we got the Q&A. Let's give us a shout out where you're tuning in from. If you can't, got any technical difficulties or any questions for the team in the background, let us know there. Otherwise, we can post. We got a Q&A, right?
Yep, in the chat. If you have any tech issues, or if you just want to tell us where you're coming from, watching, where you're tuning in from, and then if you have any questions, put it in the Q&A if you would.
Yep.
We have our crack team there. We got Patty, Amanda, George, Jeffrey, and Troy right now.
Nice. So you got a couple CPAs in the Q&A, plus legal, plus our whole Anderson process team in there. So we're going to be going through some fun material today. Keep the questions coming. Stay engaged. It is, tax stuff. We got to put the extra mental effort to wrap our head around some of these concepts. But very happy to have you guys here. A couple of the bullets here. If you need a detailed response, we really like doing these formats, guys, because we're trying to bring you as much information, fire hose blast, free of charge for those of you that are clients as possible. So that said, if we're looking for calculations, or we have a lot of moving pieces, or you need a detailed analysis of a situation, set up a tax call, become a tax client. We're already tax clients, but you can set up a tax call with one of the advisors here. Simply because we just don't want to steer you off in the wrong direction here live. like to give you as much guidance as we can, but if there's specific guidance needed, set up a separate call. But fast, fun, and educational.
And I think, as you can see, we get people from all over. We got Detroit, Seattle, North Carolina, Wisconsin.
Nice, great. Yeah, and I love this last part. We want to give back and help educate. Of course, we'd love it if you became clients, or many of you are already clients. But really, this stuff, we kind of just have to get this out to the masses, guys. No, it seems like this wasn't taught in public school. A lot of this financial literacy and how do we handle taxes and bookkeeping and all of this, handle our finances. So we want to give back and help educate. It's certainly one of the missions here. That's one of the reasons I'm here at Anderson. I have an MBA and I'm a CPA also, but taxes and accounting, boy, that's some heady stuff.
Good stuff, huh?
I learned that just so I could interact with business owners. I really like just kind of the educational aspect of what we do here at Anderson. I really appreciate that. So I hope you guys get a lot out of it. That said,
we gotta have the debits equal the credits.
That's right.
It keeps us straight.
When it comes down to it, it's got to balance it all out. That's right. What you own and what you owe. Let's hop right in. Anything else we want to touch on before we?
No, just again,
some questions.
We appreciate you bringing in the questions. Had some great ones, and I picked up some that covered. Maybe we had 5 or 7 in a certain area, so I'd pick one from that area, and we'll see what we got.
We're going to skim through the questions real quick to just give you guys an idea of what we're working with here, and then hop in with a lot more detail. So here we go. Regarding Section 168 bonus depreciation. Ooh, that's a good one, right? 168 bonus depreciation. It says to qualify for 100%, the property must have been purchased after January 2025. Ooh, it sounds like we're talking about some new regulations here. Does that mean the property purchased in 24 but not put into use till 2025 would not qualify? Great question. We're going to be going over that.
Next one, what are the tax implications of shifting properties from the short-term rental to a long-term rental after leveraging cost segregation reports to accelerate depreciation, offset some W-2 income? We've materially participated with the short-term rentals for the past 2 years. So we got them mixing it up there.
Yep, got some buzzwords in there. Can you use short-term stock loss carryover to offset real estate depreciation, recapture, and capital gains, right? We've got short and long-term stock and how that all. Yep, capital gains, capital assets.
In the state of Florida, could parent fostering be conducted as a nonprofit business entity? I was considering getting licensed and want to evaluate the possibilities within this field.
I'm glad you picked that. It is kind of one of our more obscure ones today, but boy, this is going to be a big issue.
Yes.
moving forward for all of us, huh?
Nonprofits.
Right, and taking care of our seniors.
Yes.
My husband's selling his orthodontic practice using a 1031 option, obviously for the real estate portion. My question is, can he pay off the existing, or rather, should he pay off the existing loan before reinvesting the profit or before doing the 1031 exchange? Great question. My wife and I have a holding company, LLC, and multiple subsidiary LLCs. They are currently taxed as partnerships. Should they be changed to S Corps? We're going to talk about entities, right? We got this kind of whole list of stuff. Disregarded LLCs, S Corps, C Corps, partnerships. How do we make sense of that maze? In a Ponzi scheme, does the discovery year have to be the year the charges are filed? We'll rely on Elliot's more legal mind for that one. As far as I'm concerned from accounting, right? You report them, we'll tax them when they get reported.
Excuse me.
Would establishing an LLC help me reduce tax on income from stock trading? Possibly. We're going to introduce a corporation there. A lot of good benefits there. And finally, our C Corp employs our son on a part-time basis. His tax bracket after the standard deduction is 0. We're planning on buying or leasing him a car for personal use. Oh, ding, ding, ding.
Yep.
We're planning for personal use. There will be no business use for the car. What are the payroll or other tax implications of each of the following scenarios? And don't worry, guys. Elliot's not dying over here. We just have we got a good,
That was Amanda a couple weeks
good
ago.
pollen dump here. We love having the spring and the flowers, but boy, it rains pollen here in the desert. But monthly lease on the car payments on his own. So buy the car in his name or put the car in the corporation's name, deduct the monthly payments as a corporation expense. But then we got this, it will be for his personal use only. Ding, ding, ding. That might cue us in on what the answer is. So we got a lot of great questions to go over today, guys. And with all of these, we can go so many different directions within each of these questions. So just trying to steer this in the way that we can offer the most value to you, keep it relevant, keep it useful. As usual, guys, make sure you tune into Toby and Clint's YouTube pages. Toby hit the 1,000 video mark. Tons of great content on there. That is quite an accomplishment in 1,000 videos about tax planning.
But he only has 493,000 subscribers, so he's not at 500,000 yet.
Come on, guys. Boost those numbers up. Get those numbers up. Of course, Toby focuses more on the tax planning side. Clint more on the asset protection. Tons of crossover, right? But we kind of distinguish those two areas of tax and law. Again, Clint focusing on asset protection. Both of them with great interviews, as you guys know. Great interviews with industry leaders, etc. Got some events coming up. What do we got here?
Yeah, it looks like our live event here in Vegas, $99.
Coming up end of this month.
Yeah, June 26th to the 28th.
I'm assuming, was that like a Thursday, Friday, Saturday? I might get a business trip out of that.
Right, exactly, yeah. Might be deductible.
Yeah, that's right. We'd love to have you guys. So this is the Tax and Asset Protection Workshop. Yep. Join us live. Great time to come to Las Vegas.
Meet other people, get that networking going on, learn a little bit.
Yep. A lot of synergy there. Tax and Asset Protection Workshop. So what's the difference here? Tax and Asset live workshop, and then we got the
Correct.
Virtual here. Gotcha.
Yep.
So any questions on any of these registration dates, how you register, where, any of the costs, anything like that, please post in the Q&A. We'll get you more information.
And while we're just, before we get into that, we do have, what is it, I think the June 12th and June 16th, we have the nonprofit workshop coming up, starting and running a nonprofit. Kareem's going to be putting that on. We'll talk more about that as we get to a particular question that we have here.
Okay, super. Well, you guys ready to dive right in? Let's tackle your tax questions. All right, regarding Section 168, bonus depreciation. That's a big one, right? Bonus depreciation, that can result in some pretty serious deduction there. It says to qualify for 100%, the property must have been purchased after January 20th, 2025. Does that, and this is, obviously this is cueing us off, guys, that we're talking about proposed regulations here, right? Does that mean the property purchased in 24 but not put into use until after January 2025 would not qualify? What say you, sir?
Yeah, I just want to point out exactly what Barley said. He's absolutely right. This is proposed legislation, and so what's happening, we're hearing this a lot. Hey, I heard that we get 100%, et cetera. It hasn't passed the Senate yet. And so what we have going on here is a confusion. This doesn't exist yet. This is not a thing. And it very well might not be. Even if they go through with the legislation, open it up, it may not be written the same way as it was. But what we can tell you is what happened between 2017 and currently under the Tax Cut and Jobs Act. And what that said is that if you did buy a property, let's say in 2018 when it was 100% bonus depreciation, and then maybe it was in 2019 when you put it into service, or maybe it's gone down a little bit, and we had, let's say, only 80%, that wasn't actually the case, but let's just say it was, then you would actually go back to the year that you purchased it and you would qualify for 100% bonus depreciation. So what we can say is that that treatment has been accepted in the past, but again, that was only during the current Tax Cut and Jobs Act portion. We don't have any idea what's going to be finally voted through on the Senate, et cetera, and if it will indeed have the same language. And it's possible, we may have to wait for regs from the IRS before we even know, depending on what they write us.
Sure, right. The final step of
Had to do that.
implementing it all, right?
It took forever for just the 199A deduction. I remember we waited, it was over a year, I think, before we had final regs, maybe a couple of years.
Right.
It took forever. So it could be a while.
Yeah, and now to your guys' credit, there's so many YouTube videos, clickbait kind of like here's what's going to happen or whatever. It's like I see all those videos on there, but yeah, we can't give guidance till the law changes. Now we're going to try and keep you up to date and abreast of any changes as we see them, but we want to give guidance that you guys can rely on 100%. So if we're still speculating about what's going to happen in the bill, then we got to just wait.
Yep.
What else? So yeah, but good points there. That's the purchase date. What year you purchase the property is generally going to determine that percentage bonus depreciation. So if and when these new laws go into place, that's what you will use to determine that percentage bonus. Yep, exactly. And 168K bonus depreciation, that's our friend. All right, what are the tax implications of shifting properties from short-term rental to long-term rental after leveraging a cost segregation study to accelerate the depreciation and offset W-2 income? Great question. And ding, 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 we materially participated in the short-term rentals for the past 2 tax years. So it sounds like you already got some good deductions there. All right, so first of all, what are the tax implications of shifting a property from a short-term to a long-term rental? Well, so we'll come back to this in a second, but you can't have both in the same year, just FYI, right? It's either a short-term or long-term. It's calendar year 1 to the end of the year. That's going to determine the status, short-term or long-term status. So if that's the scenario, that's kind of the answer. You can't really have a short-term rental half the year, then make it long-term the rest of the year. That will, by default, generally default to making the property long-term rental. So just to want to throw that out right off the bat.
And also, I think what we want to look at here is the concept of short versus long. What you're going to have here with a short-term rental that's called commercial use, typically the building's going to be divided by 39 years and you depreciate a little bit each year, straight line depreciation. Long-term rental, typically it's going to be 27 and a half years. Now, where the whole accelerated depreciation comes in, we're going to have something done, some kind of study done, yes?
Right. Cost segregation study.
Exactly.
Segregate each of the asset classes, right?
Mm-hmm. So effectively, what we're breaking that property into pieces, as I call it.
Yep.
And so we may have, like, again, I look around the studio here, we got lights. Well, certainly we got lights. We got no AC though, but we got lights. We got wires, carpet, what have you. And then of course we have the building. All those have on their own depreciation life.
Yep.
Cost segregation study breaks it into those pieces. So you have some 5-year properties, some 10-year or what have you, and then some 27.5 or 39-year property, depending on if it's commercial or short-term rental. So what they did is that they did a cost seg study, broke it in these pieces. Imagine if they'd spent $30,000 was the value of the purchase of that building towards carpet. Instead of being a little bit deducted over 27 and a half years or 39 years, it was all sped up for 5 years to be deducted. That's going to cause a lot more depreciation right away. And you take all those assets that have that shortened lifespan and you get a lot more deduction up front. So that's what there is going on here. Now, short-term rental simply, for our purposes today, just means that the average rent was 7 days or less per year. And again, it's over January 1st to December 31st.
Calendar year. Yep.
We don't, just as Barley pointed out, we're not going to break it into, you can't do one for 6 months, the other for another 6 months. It's going to be one or other treatment throughout the year. And that's how we get long, otherwise it's long-term rental. Now, they also mentioned that they materially participated as a short-term rental. So they started with short-term rental, and they materially participated. What's going on there?
Right. Well, with the short-term rental, it's kind of unique. Not technically a rental, more like just an active business if we're materially participating. Short-term rental, we don't have to have that real estate professional status test, that the much larger 750-hour test. We only need to meet the material participation test.
And why do we care?
Because if we want to go the other way, well, we care because we could recharacterize the losses.
Exactly.
These potentially large depreciation losses, right? But going the other way, I have a short-term rental, I'm materially participating, getting these great benefits, I'm going to make it a long-term rental. Same thing, right? Not really. That's where we need the real estate professional status to then be able to materially participate. That's for a long-term rental. Short-term rental, you only need to meet that material participation test. But yeah, that will recharacterize these typically large depreciation losses from passive, where they could typically only offset other passive income, to active losses eligible to offset all other forms of income.
Exactly right.
That's what we want.
And so what we started with in this scenario is a short-term rental that we did materially participate, the shorter, the easier test, if you will, as Barley points out. So they did the cost seg. It created all this depreciation deduction, gave them a huge loss. That loss, because they materially participated, became an active loss. It offset their W-2 income. It's a win situation for them. They got a great deduction. Now they say, well, Elliot, I did that for 2 years, and now I want to turn it into a long-term rental. What's going to go on? Well, as Barley points out, if they become a long-term rental, they're not going to get that same non-passive activity unless they're a real estate professional. They get the real estate professional status, which is a much more involved, typically, test. So they may not get that, and they may not care. If they got all the deductions early on, that might be fine with them, and they just want to turn it into a passive activity.
Won't change any of your previous active losses.
Exactly right. And so it could have been a very good play for them. They got all the deduction up front. They don't care if they get a few passive losses, they get trapped later on. They're happy with that, perhaps.
Turn it over to a manager. Yep.
But they certainly want to be aware, just so that they know. Now, another thing that's going to happen here is, as a short-term rental, it was the building, that is, was what we call a 1250 property, and that's going to be divided over 39 years, and you take a little bit, again, each year. When it becomes a long-term rental, that same 1250 property, which is just the building, it's going to be over 27 and a half years. So they would take over whatever remaining balance is left in the building, as far as that hasn't been depreciated yet, and they'll divide it by 27 and a half, take a little bit each year. But when they did the study, it broke it from 1250 to 1245 property, again, the 5, 7, 12, 15, whatever years of property, tangible personal property, 1245. How are we going to depreciate that? If it was 5-year property and they had 2 years, what happens then? Any ideas?
You just keep it going.
Exactly right. So they had 2 years of the 5-year property, the carpet being deducted.
It's 5-year property.
Exactly, and still going to be 5-year property, and they just continue on that as was. So really easy there. It's the 1250 they have to worry about later on.
Yeah, and just to reiterate, guys, so the depreciation, remember, it all pans out to be the same at the end of the building life. We're trying to accelerate it. Why? Because $1 today is worth more than $1 tomorrow. Maybe we're in a higher income tax bracket right now. We want to lower that income as much as we can. You know, if we're getting less depreciation expense in 20 years when we've retired, maybe that isn't such of a big deal. Kind of bottom line, this all goes back to tax planning, right? This one little fact can change the whole pattern, right? So if this pertains to you, then let us know. We can certainly provide more guidance here. But yeah, and that's kind of heady stuff, guys. So, you know, the 1245, 1250 property is kind of the separate pieces of the house. If you think about it, you got the house with the roof, the foundation, that's being depreciated over X amount of time. He's got all these smaller components in here that are also being depreciated over that long period of time. If we can speed that up, we get a benefit today. That's kind of a complicating tax concept, isn't it?
It is, but it's a good one.
It is a good one. Accelerated depreciation.
But a lot packed into that question.
Yep. And you know, that's just to throw another little layer of detail on there for you, those of you that are really into this. Remember, accelerated depreciation. We're just correcting the depreciation, getting it to where it's supposed to be. We can even add bonus take even more in the current period. We get a bunch of good deductions when we talk about depreciation through real estate. Do you want to go over any questions or any
No, I
questions
think this leads us well into the next one.
Yeah. All right, this is a good one. Let's put on the tax hats here.
Mhm.
Can you use short-term stock loss carryover? Right, we got capital loss carryover is what we're talking about. Capital losses are limited to offsetting capital income. The balance can carry forward. To offset real estate, can we use stock loss carryover to offset real estate depreciation recapture, like we were just talking about, and like other capital gains is what's kind of implied here. And yes, kind of, and it's an ordering operation. Ready to have some fun?
Yep, and it is. And Bartley and I were going through an example here, and I think we'll go with that. I think that worked really well.
$10 capital gain. Yeah.
Excuse me. Yes. So we have a situation where Barley listened to Elliot for some stock advice. Okay, and of course he lost his shirt on it. He's got oodles of stock loss. No problem there. But fortunately, he listened to Toby for some real estate as well. Made a lot of money.
Made a little back.
Exactly. Made a lot back. Okay. So what happens when he tries to combine the two? Well, when it comes to the real estate, let's just say we had $10 a gain. There's a lot of things. The ordering, I think that was a perfect description there.
Right.
We got an ordering of how this happens on the return or in the tax code. $10 of gain on the sale of the building. Okay, we're just talking about the real estate gain right now. Let's say $1. First of all, we got to take in any passive loss that rental had created. So let's say he'd run a rental and it created some passive losses. Well, those are released once he sells that building. Let's say that was $1.
Yep.
Okay, so now we had $10 a gain. We got $1 offset with some passive losses directly related to that building. We have $9 left. Then you take all your other passive losses out there. Let's say that was $2. $9 minus 2, that leaves us with $7 left. So we have $7 of, at this point, what I'll call technical capital gain.
Right.
But then the code stops us, and it says you got to do depreciation recapture. That gets
Before going to step 3.
Exactly. And
Must
so,
take.
but it gets all the way back to where we started on the progression of these first couple questions, where maybe he's done a cost segregation. He has 1250, 1245 property. So he's going to have to, let's say there's $2 worth of depreciation recapture. He's going to have to pay tax on that. Whether it's 250 or 1245 will determine how much. If it's 1250 property, he'll pay a maximum of 25% depending on his tax bracket. And if it's 1245, after a study's been done, it will be taxed at his ordinary tax bracket. So now we've taken care of 9 minus 2 on that, 7, the depreciation recapture. I think now we're down to $5 total.
Yeah, $4.
We got 5 left, I think.
Okay.
Now, let's say he has $2 of capital loss. What we have left is just capital, pure capital gain, I'll call it, $4 or $5, wherever our math left us. He now can use those stock losses from what I advise him to invest in. He can marry that up and offset the rest of the gain.
Right.
So now all of a sudden, yes, it really is. We can get to where we can use those losses, but we got to go through a lot of steps first. We got to go through the order of how the code draws us or the path it takes us through. And that's what we got to do. All the passive losses directly related to the building. Number 2, all other passive losses, depreciation recapture, and then finally, whatever's left over for gain, we can use other capital losses to offset that capital gain.
Oh, that's a lot in one question there.
It is.
That's a good one.
But it is. So,
and for those of you following along in your tax returns, you can open Schedule D, right? Top half of Schedule D for reporting sale of capital assets, short-term gain, long-term gain. Flip the page right over there. There's that total at the top, and then we add in that 1245, 1250 depreciation recapture part, and then we get that total. That's where you can either have the capital gain or you'll have a capital loss up to $3,000, offset your other income in the current period. The balance carries forward, right? You know the rules from there. All right. Any questions? Should we keep it moving?
Yeah, I think we're good.
All right. Here's a good one. This sounds kind of legally. State of Florida could parent fostering be conducted as a non-profit business entity? I was considering getting licensed and want to evaluate the possibilities within this field. Great question. Obviously, you're thinking about giving back, potentially maybe setting up some sort of nonprofit. how do we know if this categorized and we can get that deduction or not?
Will this work?
Yeah.
Well, we went straight to the top. We went to Kareem,
Yeah,
actually.
straight to
We
Kareem.
had our ideas of what the answer was, but we knew we had an ace in the hole, so we talked to Kareem about this, who handles our nonprofit department, worked for the IRS for a significant period of time. We can't really do it as described in this question. And what I mean by that, if you can imagine that you're going to be have a foster child, we can't have a deduction directly in a nonprofit for that child for our operation. You said it perfectly when we were talking about this. You can't really set up a nonprofit for a specific person. Right. You can for a specific cause, with a general populace out there, but we can't earmark for one particular individual, which is what we're asking here in a sense. It's flat out is what they're asking. So if I wanted to be a foster parent for it's going to be for a child or two, I can't really do that through a nonprofit because I'm earmarking it towards those children precisely, and we can't do that with a nonprofit. It has to be open to the larger group.
Public, yeah.
And so no, that won't work. But what could work is if you were just helping out that purpose of parent fostering, helping foster children, as more of investment in the structure and other improvements, the support of that nonprofit purpose. There may be other things that they need funding for, as a general purpose, and so you could set up that kind of a nonprofit. Money goes in there, and as a general, you have a general purpose for the funds, and you spread it out to the greater good, if you will, not a particular person. Then you could probably work with that. If at the end, of course, you want to talk to somebody who does do this. Kareem is a good example of that. I think we have, every week on Thursday at 10 o'clock, we have the nonprofit hour.
10 to 11, yep.
Yeah, the public knowledge room.
Yep.
We do have, as we mentioned earlier, he's going to have the start and running of a nonprofit from 9 to 1 on June 12th and June 16th. If you have any questions about how to get there, just look at our website. Maybe Patty has the links, perhaps. I don't know if they're up on the website or not. But those are two areas where you could learn a lot more about nonprofits.
Yeah, it's all the basics. Plus, you'll have a really good idea of what you need to do from there. And yeah, great. We went through this with a lot with the fires, the wildfires. I want to give some money to my neighbor to help them rebuild their house. Is that a nonprofit or a tax deduction? Generally not, but you could give that money to a local nonprofit that helps people rebuild their homes after fires, or in this case, that helps provide foster care for whoever. You could donate to a local, or you could set up your own nonprofit that does that. It wouldn't just be an individual service; it'd be a service offered to the general public. But yeah, we have a killer team here. Kareem, Savannah, let us know if you have any questions on that. Plus, yeah, like Elliot mentioned, every Thursday, 10 to 11 a.m. Pacific time, every Thursday, our nonprofit open office hour.
Exactly.
All right, keep it moving.
Keep it moving.
All right, my husband's selling his orthodontic practice utilizing the 1031 option. My question is, can he pay off the existing loan before reinvesting the profit? Well, you certainly can. Do we want to, though?
Well,
So are there tax benefits to it? Obviously, is your question there, right?
Yeah, and so we're selling a practice, and we bring up 1031. So what that's telling us is that there was a building involved, because 1031 is the like-kind exchange provision, but it's only for real estate. So we know there's a building involved here, and not just the practice, and perhaps selling of the patients, the
Client list or
client
whatever.
list and what have you.
Patient list, yeah.
And outstanding invoices, et cetera. So the building part, 1031, they're trying to exchange that. What happens there when that actually goes on? First of all, you want to have a qualified intermediary called a QI. They are kind of the quarterback that oversees everything, but maybe better described as the referee, because they don't really represent any one party. But they will receive the funds from the selling of the building. So in other words, we had the doctor's building or orthodontics building. It was sold. Money was received by the qualified intermediary. You can't touch it as the seller, okay? So the qualified intermediary, the QI, receives the cash. And they're going to be obligated probably to pay off the loan on that building. I think that's what we're asking here, the existing loan, can we pay that off? Yeah, they're going to take it out of that cash. But in order to have full deferment, what that means is in order to defer the gain on the sale, you're going to have to pick up a building. We have to buy another building or buildings with the cash from the sale. So if we sold at $1 million, basically we have to pick up another $1 million, and you have to pick up equal or more debt. So in other words, if we sold a building for $1 million and it had $300,000 of mortgage on it, yeah, they're going to pay off that mortgage. I don't think you have an option. I think they're going to require that be paid off.
Clear the title and
Exactly. When you buy the new properties, the replacement properties, you're going to have to spend at least $1 million, and guess what? You're going to have to pick up more debt, at least $300,000. If you fail to do that, you're going to have some boot, as we call it in this in the 1031 calculation, and that means gain. You're going to have some taxable gain. So if our goal is to have full deferment, we got to buy a building with the same, basically the same or more fair market value, if you will, and the same or greater debt. Is kind of the simplistic way of describing it if we have full deferment. So can they pay off? Yes. In fact, I think they'd probably be required to pay off the debt, the pre-existing debt, and they're going to have to pick up more debt with the replacement properties.
Mm-hmm. Yep, handle it through the QI.
Yep.
Set up a tax call if you want to cross the T's, dot the I's. You know, if you have any concerns or whatever, we can certainly go over these a lot.
And we do have a recommended qualified intermediary as well.
Yep.
That has done very well by our clients.
Mm-hmm, mm-hmm. Yeah, great question. And of course, business use real estate. Ooh, what's this? Got a workshop coming up? Tax Tuesday. Use code Tax Tuesday. Join us live. June 22nd, 28th. Come on, join us, guys. Tax and asset protection workshop. Also, if you want, you can schedule a strategy session. And meet with our team, talk about your blueprint, let us know if you want more information on that. Obviously, this is a lot of the goal here is just to give you guys information. If this pertains to you and you say, this relates to me and I need to know more about this, submit us a Platinum Portal question, set up a call, let us know how we can guide you further. A lot of options. All right, my wife and I have a holding company LLC. What's an LLC? And multiple subsidiary LLCs. They are currently taxed as partnerships. Oh, well, that answers my question. They're taxed as partnerships. Should those be changed to an S Corp? Well, a lot of ways we could answer this question, right? It's very general, but let's talk about it from a couple different perspectives. Let's go real estate first.
Yep.
So what do we think about?
So again, to your question on LLC, limited liability company, we always ask, well, how's it taxed? Fortunately here, we were told it is taxed as a partnership because it can be taxed many different ways. But partnership, what we want to know is what are we doing with the business or with the LLC, excuse me. If it is a business, an operating business, Toby's Pizza Shop, we might want to run that into an S corporation, okay? But if it's rental property, you go out and get 3 rentals, that we likely want to have in a partnership. Why? Well, rentals, appreciable real estate property like that, we never want to put in a corporation, S or C. That has tax consequences down the line. Yeah. You just don't run into as favorable a position as you would by keeping it in a partnership if it's real estate. So we wouldn't do it there. Now, Toby's Pizza Shop, the building, Toby goes out and buys a building. Hey, I'm going to set up my pizza shop in there. Yeah, we might put the building in a partnership, but the actual running of the business, we got Amanda managing, we got you handling the clients, the customers, and I'm making the pies, getting everybody sick. So, that operational part might be in an S corporation, and that's typically where we make that decision. Yeah, so we really want to know what are you doing in your business, I think, to make that decision. Would we ever make a change? Let's just say that it was a business, an operational business, and it was a partnership. Would we ever recommend going to an S corporation? Well, I think yes. Yeah. And any ideas why? Usually
just flat out income numbers. You're subject to self-employment tax from all that income. You're not considered an employee of the business, so you can't really do all these great reimbursements that we talk about a lot, at least not as easily. So a lot of benefits to being when you own and control an incorporated entity, you're considered the employer and employee. So now all of a sudden you can be reimbursed as an employee, You can max out a retirement plan from both sides. You wear both of those hats. That kind of inherently creates this whole benefit. That's with a corporate structure. Partnerships, like Elliot said, they're perfect for real estate. We can put real estate, we can put it in and out, take it back out. Same with a disregarded LLC. Very, very flexible for holding assets, holding real estate, holding income producing assets.
And just as a thought, let's look at that. Let's say Toby's running this pizza shop and it is a partnership. Well, he can pay us as staff, and that will be a deduction. He can even, and people will always misunderstand what I say here, but
Oh boy.
he can, because he has employees, he can set up an accountable plan reimbursements for us employees, but he can't for himself.
Oh yeah. Oh, I thought you were going to go into UP.
Right.
I was like,
Yeah,
no.
no.
Right. You can have employees. A sole proprietorship can have employees. A partnership can have employees. You're just not considered an employee of the business.
Right.
That just changes things a little bit there.
So we got no 288, any of that business going on.
Right.
But now, let's say he is an S corporation. Well, now all of a sudden, Toby can do 288 off the top, get a deduction there. He can do his reimbursements for himself, and a lot of that's is discrimination plan. So he doesn't have to worry about. He doesn't have to give it to us.
Right.
He can just keep it himself, do his 288, et cetera.
Reimburse whoever you
He's a
want.
pretty good guy, so I don't think he'd do that to us. But anyway, he can do that, and that's just going to put him in a far more favorable tax position by being an S corporation for that running of that business. So again, hopefully what you can all draw from this is that the decision between being one or the other, of course we're going to look at a lot of facts, but there are some broad highways that send us one way. If it's real estate, we're going to go partnership.
Right.
If it's an operating business, we're going to try and get in that S corporation branch.
And just structurally, you can't have like an S corp has these rules about who can even be an owner.
Oh,
So
good
a
point.
partnership can't even own an S corp technically.
Yep,
Has
Exactly
to be
right.
individual shareholders with even other restrictions other than that.
correct.
All right, good on that one.
Yeah, I think so.
Okay. Ponzi scheme.
Yes.
Uh-oh.
Yeah.
The old Madoff. In a Ponzi scheme, does the discovery year have to be the year charges are filed?
All right. So a
So
tip,
discovery year, that must be a key term in there, huh?
it is, as far as when you found out about it, is typically the year you can deduct it. Now, to get the Ponzi, you basically have to have the government telling you that it is a Ponzi. In my experience, when I've had clients come to it, they've had letters from the FBI, things I didn't want to read. First see that and you're just like, whoa.
Yeesh.
And then you realize it had nothing to do with me, so I was happy to read it. But you're going to have some kind of federal government form, or even a court docket I've seen on others, showing that, hey, this is a charge of a Ponzi scheme. And you become aware of it. And that's typically what they say, once you become aware of it, yes, you can go ahead and take a deduction that year. That is the general practice. Now, if it doesn't get that government approval, I'm not so sure it qualifies. And what we're looking at is a theft loss where we may not get much of a deduction as an individual. So
Right.
that's why it's important.
Right. We can't decide if it has to be some sort of official ruling from the government saying it's an actual Ponzi scheme.
Yeah, so I've seen clients have to wait on that. Well, then that's when they can typically, go ahead and take the deduction. Now, if it's already been declared a Ponzi scheme, there is what they call a safe harbor as well. It's a little bit of a different idea. We know it's a Ponzi scheme. We're in the year that it was filed. You can go ahead and take a 95% of the amount lost deduction right away that year. In other words, court cases could take forever. Okay, so if you're going after a third party, they'll let you go ahead and take the majority of it, 95% as a deduction right away in that year, as long as you're going after a third party. If there's ever if you gain anything, they find a settle or whatever, you get money back. Well, then it comes back and it's adjusted accordingly. Also, there could be a 75% amount you could take right away if they're not going after a third party. So there's some specific rules with the Ponzi, but those are kind of the guiding rules that I would go with as far as determining if you can even get started down this path.
Right. Yeah, those would be looking at a capital loss with the related limitations.
This would be
potentially.
it would be if it was the thought, you may not get any loss depending on
Or
what
any,
happens. Yeah,
Right.
the Ponzi. That's why the Ponzi labeling is so critical,
Right.
so that you can get that ordinary loss.
Right. Excellent. Great question. All right. Would establishing an LLC help me reduce tax on income from stock trading? I like this question. I'm a big fan of our what we call our trade structure. Uh, if you have regular capital gains coming in, more than a few $1,000s, and especially if that's kind of a good source of income for you, there's a lot of benefits here to potentially setting up a trade structure, trading using a corporation as a trading partner. But let's start from the basics here. So would establishing an LLC help me reduce tax on income for stock trading? Not necessarily inherently. Because we can say we have a big crypto or brokerage account, we could put that in a disregarded LLC just for kind of safekeeping, more of a legal treatment than a tax treatment, right?
Yes, sir.
But in the case if we're actually trying to reduce taxes, we can get it's not active in terms of material participation, but we can get a little more active involved in here. We can set up a corporation as a trading partner. And essentially, that just means we set up a partnership, and you're one partner, and the C Corp that you own and control is the other partner. So why would we do that? Because of these corporate benefits we've been talking about, these reimbursements, shifting income to the corporation, charging a guaranteed payment, having it manage the portfolio for you. Bottom line, big picture, when we get to the very end here, you can either have $100 of capital gains hitting your personal tax return on Schedule D and all of it being taxable, or you can have $90 of capital gains hitting your taxable return and $10 of that coming back into your pocket as a reimbursement, like we touched on earlier. Essentially shifting a chunk of money up to the corporation, but before that's taxed, right, reimburse as much of that back into our pocket tax-free as a reimbursement. So it kind of just takes a chunk of that income that would normally hit your return, makes it tax-free.
And so, can it help reduce taxes? It could, but really what you want to do is calculate to see how much that projected savings that Barley's just talking about, well, is that savings, is it worth the cost of setting up the trading structure? The added tax returns, because you're going to have two. You got a partnership return, and now you got a C corporation return.
Yep. And the related bookkeeping.
Yes, exactly. And so it might be worth it, but we have to calculate that out.
Mm-hmm. Yeah, and so, for those of you that are all in on this stock trading stuff, making decent capital gains, you've likely heard of this option. This is a great option, potentially. Now, we're talking about shifting capital gains, but we're also talking about using a corporation as a trade partner. So just kind of disregarding the whole trade aspect of it, now you have a C corporation also that can pay you a W-2, set up a sponsor a qualified retirement plan like a solo 401k. Right, it can reimburse you for your medical expenses. Right, it just opens up a lot of doors when we have a corporation as a trading partner.
It certainly does.
Yeah, lots more on that one, guys. Let us know if you have any questions on that. There's a guaranteed payment portion to that. It kind of gets a little nerdy. But again, there's the whole W-2 qualified retirement plan you can set up, medical reimbursements through a C corporation. None of this is in the question, but when you're talking about how do we reduce taxes from stock trading, that's going to be generally the first thing we think of.
We're nerdy, huh?
That's right. Well, yeah, somebody's got to do it. Alrighty. Well, let's see how much time we're doing. All right on time. Oh, good.
Yeah.
We got a little time left. All right.
Well, after this one, though.
Right. Yeah. Our C Corp employs our son on a part-time basis, which we talk about a lot. Hiring the kids, right? Put them on payroll. Lots of benefits there. Pay them less than the standard deduction. They generally won't owe any tax. Then they'll have earned income eligible to be contributed to a Roth, right? Plus they can learn about financial literacy and business operations and taxes and bookkeeping, all that fun stuff, right? His tax bracket, after the standard deduction is zero, we're planning on buying or leasing him a car for personal use. And well, spoiler alert.
Kind of want to circle that in red.
Spoiler, yeah. Skipping right to the end here. No, there will be no business use for the car. I guess we could circle that.
You just...
Well, that kind of answers it. But let's go through the question. So, what are the payroll or other tax implications of each of the following scenarios? One, we buy the car in his name, increase his part-time salary so that he'll be able to make the lease payments. Or two, buy the car in the corporation's name so we can deduct the monthly payments as a corporate expense, provided so he can use it and report the monthly lease or loan payments as a benefit to him. Note the car will not be used for the C Corp business. It will be for his personal use only. I like how they reiterated that part there.
Made it very
clear. You guys didn't catch that part there. So, yeah, obviously we're talking about personal use assets within a corporation. But let's start from the top.
Yeah, I think on the number one, yeah, you're basically by buying the car personally in the child's name and just increasing the salary. Well, there you have a legitimate way of doing things.
Yeah.
You just simply pay the child more so they could pay for the car. That's great because then the child's paying for it, taxes are paid accordingly. Nobody has a problem with that. And they're not using the car at all for business anyway, so why would we want to connect the two?
Right.
Okay, and that's, this keeps us out of a jumpsuit, I think.
Yeah.
Not that it's really criminal, but it certainly keeps us out of the red for an audit.
Yeah.
Um,
Cars
and-
are just one of those things. Highly audit, lots of liability.
Right? Exactly. Yeah. So we want to be careful with the vehicle. So I like number one right away. I'll just tell you that. You feel the same way on that?
Yeah, I think we're on the same page there.
Yeah. And the corporation's going to get a deduction for that salary. So you're going to get, you're going to get some in effect, in the way the corp is getting to pay for it, if you will. Although the child actually pays for it, but you'll get the salary deduction. This number two, though, buy the car in the C Corp's name, right there, no. Because we have no business purpose or desire, or we're not going to use it at all as a business. So I think we get more into the legal aspect here, potentially. You got this vehicle, and you're really mixing personal asset and use with corporate.
Yeah.
And that might pierce the corporate veil. Maybe not. I don't know. I'm not familiar with up to date with the cases on that, but it's certainly a road I would not want to go down.
Yeah, it sure sounds like something we'd say a lot. Hey, if you use your corporation to buy yourself a personal vehicle, that's piercing the, or at least commingling of assets.
Right, and so you're really putting the whole structure into jeopardy
Yeah.
for no real purpose. If you just take an option one, we wouldn't even be having to worry about this. And reporting the monthly lease or loan payments as a benefit to him. I mean, I just don't like it. I don't like an asset being put into the C Corp that's not being used for the C Corp. I just think that gets you into trouble.
Now, if the car's in his name personally, 100% personal use asset, and you said he is an employee of the C Corp, so if he had to do a business trip or something with the car, you could potentially reimburse him for mileage, right?
Under the right circumstances, mileage might be reimbursable. What are those circumstances? Well, excuse me. If he has to drive from the office building of the C Corp to somewhere to make a supplies run or something like that, that'd be reimbursable. Yeah, we could probably get the mileage in there, but
Right.
that'd be about it.
Yeah,
I think.
just throwing it out there,
You're right
But
too.
I think you would. Yeah, you're definitely going to want to keep it in your personal name. Now, change the fact pattern. We're buying a car. It's going to be for 100% business use. It's a plumber van full of all that stuff that rattles around all day. Well, you likely wouldn't be allowed. If it's a business use vehicle, there will be a lot of regulations, county and state, city regulations, likely requiring you to license a business vehicle in the name of the business. But obviously that's not what we're talking about here. No business use, 100% personal. Keep it in your name. That's going to be the easiest in most cases anyway.
Yep.
All right. Well, how are we doing in here? Got any questions we can answer?
I think that's
The
about
team's
it.
knocking them out.
Yeah, they got them.
Good work. Yeah, we got a couple of our tax reps, attorneys, CPAs, the
Yeah,
whole.
Patty, Amanda, George, Harry, Jared, Jeffrey, Tanya, and Troy again, just kicking it out.
Good. So I hope you guys got a bunch of good answers to your questions. Now, again, just to reiterate, anything we covered today, if you want more detail on it, submit a Platinum Portal question, set up a call. We always go way further into the weeds
Oh yeah, we can. Yeah,
in all these topics.
we can
but just,
totally ruin your day.
Yeah, right.
We can waste all kinds of your
Really
afternoon.
give you a migraine. But no, we obviously just want to, again, expose you to the concepts, provide as much of this educational material as you can. If this applies to you, please let us know. We can give you a lot more guidance where that comes from. All right, guys. Well, just kind of wrapping up, please make sure you subscribe to the YouTube pages. Just a ton of good information on there. Can't stress that enough.
The man himself.
You're right. The man himself. A lot of good, more real estate stuff recently as well too. Starting to plan for what's coming up in 2025, and check out Clint's page, and of course join us for the live events. Well, Tax Tuesday. We got this every other week, guys, and just to stress, this really is kind of about your general questions. So please submit questions. We really like seeing all the different types of questions. So we got the Where's our?
We certainly brought it this week.
Well, we brought it this week, yeah. So the email to submit questions, you guys know the deal. Every 2 weeks, we'll go over this. We'll keep it coming. Also, please keep an eye out for emails on quarterly tax planning seminars, live stream webinars as well. And of course, the Platinum Knowledge Room, 5 days a week, 5 hours a day. Please take advantage of that service. I know I certainly would. You got the attorneys, CPAs in there, 5 hours a day, 5 days a week. You got a whole professional services team on call, so please use that service as well.
Yeah, I think on the last page we get the, there we go.
Oh, here we go, yeah. There is our email.
Tax Tuesday at Anderson Advisors. I look at every question.
Yep, he does.
It's
Reads
been
every single
years
one.
since I ever skipped over any. Not that I'd ever admit to it. I guess I just did. But it's been a long time since I ever did that. I read every one of them, and they're good. They're thoughtful.
Yeah, it gives us a
appreciate
good beat on what is important to you guys too.
Exactly.
And not just to you, but I mean, you guys have the same concerns the market does. We're all kind of facing the same concerns here in this environment. So really like going over your guys' question gives us a good idea of the kind of the pulse on the market too. So, all right, guys, anything else?
I think that's it.
Yeah,
Thank you
thanks,
so
team.
much.
Great work today. Definitely commend you guys for learning tax and legal all at once, drinking out of the fire hose. We'll be back here in 2 weeks. Please keep an eye out for, again, upcoming webinars, live events. Really would love to see you guys come and join us here in Las Vegas, and we'll see you next time.
Bye.
Thanks, team.